Hello, this is Martin from seekedge, the channel for learning about trading and investment. Welcome to another episode of Risk Management for Trading series, and today we are talking about the margin benefits and option hedging. Let's try to understand the terms margin and hedging, the definition wise. So the reason why this particular video is made is because many of the beginners are not aware of what exactly is hedging or how exactly to use hedging for their benefit, right? And what are the risks involved and how to leverage the hedging and get the margin benefits and trade and do the effective use of their capital. So that's the reason why we have thought of coming on with this video. So what is a margin? The last video we have seen the margins, right? We have talked about collateral, which is one way of leveraging your investments and making use that for trading option selling, so that you keep getting the interest for this investments. At the same time, you can leverage that to further increase the you multiply your money basically, right? So margins, so the buyer of the option always has got a liability that is limited to what is the premium that is being paid. So that's why there is no margin involved for an option buyer. But in the case of seller, the potential losses are very high. It's unlimited is as per definition. So therefore, that's the reason why in order for us to do option selling, it's capital intensive, because that risk that is involved in the case of option seller, to cover that, there is a margin amount or an amount that has to be deposited through the broker to the exchange, right? This is a security against any adverse movement that happens for the option that is sought. So that security deposit is what margin is all about when you talk about margin in options trading and investment, whatever. Now coming to hedging. So hedging is what the term hedging is used in many things, many assets, not just options. So hedging is a strategy where investors or the traders would like to reduce the risk, right, and cut short the risk, basically reduce or cut short, right, the risk of the asset that is being used for trading, right, by transferring that upside or the downside risk to another asset by buying or selling another asset. That's what the hedging is all about. So option position can be hedged, right? Positions that we are using for trading can be hedged, or these options themselves can be hedged against other assets, right? For example, we buy stock and then hedge using options, or options themselves can be hedged. So there are two different ways. So hedging strategies will limit the loss, and it will reduce. It will not reduce that much of the returns, but it will definitely reduce the return. Return of investment will be reduced when you are hedging, because you are taking another asset on another and you have to pay for that, right? So, but it will not significantly reduced, considering the fact that it will limit the losses. So this two terms are is something that we have to be aware when we talk about options. How to leverage the capital for the options trading. Let's proceed. Now, what is the current scenario? So if you look at the margin requirements for option selling for a Nifty index, we're not talking about stocks. Stocks will come to 2 or 3 times more than this, depending on what is the price of that stock that we are trying to do the options trading. So we are talking about a Nifty index score, right? As per the new revised lot size of 50, if you see Nifty July end call option, if you want to sell, it will cost you 86,000, because the lot size is 50. Earlier it used to be 1.5 lakhs per one single lot, right? So that is a kind of premium. That's the kind of margin that's required. Look at Bank Nifty. If you want to, suppose you want to sell a put, right, for 29 July 34,000. If you want to sell, you are bullish and you want to sell, means you will require slightly more, because lot size seems to be put as 25. So 1,28,000 is required for one single lot. That's the kind of capital intensive nature of the margin that is required for the option selling, right? Now, how do a beginner or even a person who has traded for longer period of time would not have this kind of capital if he wants to make a reasonable profit for a on a monthly or yearly basis if you take it. So how do we solve this, right? So this is where hedging comes in, right? So hedging can be done in for different purposes and different ways. So hedging can be done to define the risk. So we have seen strategies in our previous video where we use bullish spreads and bearish spreads and then non-directional option strategies and all. They are, so basically they are risk defined. So we use the hedging for having refined risk by taking options on both sides, shorting and longing both, and then so we define it. So that is one way. Another one is to get the margins benefit. So we use hedging for both purposes. See, bullish or bearish option spreads that it's fundamentally used for risk, reducing the risk, right? Non-directional strategies like iron counter and butterfly, which you are going to see later, right? So such kind of option strategies are used for, again, reducing the risk primarily. The margin benefit comes automatically, but the primary purpose is now option selling, just like how we have seen previously, like selling the puts or selling the calls. So this is what if we are doing, then we would we could still do hedging there, right? By just buying a FAR OTM options for hedging purpose. So these are the multiple purposes of using the hedging. So for example, risk defined. So here, what is the advantage if you see here? What's happened is 16,000 call. What we have seen earlier, 16,000 call is solved, right? You have an unlimited risk and you have estimated margin of 86,000. We already seen that, right? And we want to define the risk, so we converted that into a spread, right? So what kind of spread is this? This is a bull spread. We are selling 16,000 call and then we are buying a 15,800 call. So it's a bull call spread essentially. So we define the risk. See what the margin has come down to. The margin has come down to 15,000. From 86,000 it has come to 15,000 something, 500 something, right? So with this 15,000, if this is 15,000, how many more lots can be purchased if your risk is defined and your view on the trade is bullish or is correct? Turning out to be correct means you are essentially leveraging, right? Otherwise, even after having around 1 lakh rupees, you just can trade just one lot, right? And the maximum points that may move maybe for an option during a intraday or a swing trade, maybe hardly 10 or 15 points, right? So 10, 50 is 500. So you hardly benefit anything if you trade one lot. So if the lot size, see if the number of lots that you can trade can multiply if you are using hedges. At the same time, your risk is defined, means you are not going to unlimited risk. You exactly know that the maximum for one lot you can incur a loss of around 12,000 or 13,000. You know what exactly you lose. 2 lots means you lose double of that. So the risk is defined. At the same time, you get the margin also. It's an example for that. This left side, what you see is naked options, very costly and no margin benefit. The right side, what you see is risk defined and margin benefit. This is another example. So here you are using a straddle. A straddle is a non-directional strategy, right? So where you don't know which direction the market will go, but you know the range that it may. You assume that the market may hover around certain range and then you trade it. But look at the cost that is involved. It is very costly. It's more than 1 lakh, 20,000 something for a strangle, and it is heavy risk if you are carrying forward a strangle overnight. The next day it's a gap up or a gap down, means you are gone. You are depending on what is the intensity of the gap up, you are destroyed, right? So look at the right side. We have bought 2 hedge positions on the left and the right, right? Basically we have purchased the strikes of the break even of both the strangle and then made it into a butterfly and butterfly. So look at the amount that we have saved. The margin has come down to 54,000, just 54,000. So it is more than half of the margin is all that is required. So we get the benefit of the risk defined and the margin at the same time, right? So this is another. So these are, so we saw that, using non-directional strategies or using spreads, you get both the benefits. Now some people don't want to go for risk defined, right? They would like to go directional without defining a range, right? They are just like option buying, they are option sellers with specific direction and conviction on it. Such people, as of now, it costs a lot. If you look at 89, 90,000 in this example, what is sold is, right? Suppose this is 15,900 is what is sold. So suppose option seller is having a view that 5900 is not going to break. So I just sell it from there, and by the end of the expiry, if it is not broken, then I get the full credit of 5,700 rupees in my pocket, right? But the risk is that if his view is going wrong, then the loss is unlimited, and that is why he has to pay a huge premium. Now he can still do that intraday or, right, overnight also, by taking far OTM options, right? So in this case 15,900 call is taken, and right side you have seen that the far OTM that is taken is 16,600 calls, right? So which comes to very hardly 2 or 3 rupees it will cost you per lot. So 2 or 3 rupees per lot cuts down your margin to half of it. It hardly costs you 45,000 for one lot. Intraday, you get the double leverage, 1 or 2 or 3 times leverage you can take this way. Here you are not going with risk defined, because the risk is defined here, but it is huge. The maximum loss is coming to risk reward is not correct, right? But here we are not, we are risk defining, but our major purpose here is margin benefit, not risk defining, right? So these are two ways. The other side, where in other slides previously what we had seen, they are purely for the purpose of risk defined. Margin benefits comes along. Here this is purely for the purpose of margin benefit. So both ways you can do it, right? Now there is some caution that has to be applied. We have seen that our margin is derivative themselves is a highly leveraged product, right? So if you multiply the lot size into the current Nifty index value of 16,000, then it is coming to multiple lakhs, around 10 lakhs or 9 or 10 lakhs of rupee worth product is being bought by us by 1.5 rupees. So that by itself it's a leverage product. On top of that, when you are hedging, we are getting additional leverage. On top of it, we have seen that we have cut down 1.5 lakh comes down to half of that. 40,000, 50,000 is half of that. So problem here is when traders do not do the position sizing properly. In the sense that suppose they have 10 lakh capital, how much of lots has to be bought? When they see that there is a leverage, if you unnecessarily buy a huge number of lots which is not in your risk capacity, if you consider the 1 or 2% of your total capital, then whenever your view is going wrong, the max loss also will multiply. So that is the problem with leverage. When you take the leverage, when you lose also, it will multiply. The losses will multiply heavily, and then you will end up. So position sizing, risk management side of it has to be very careful. Another thing that has to be careful is execution. So in order to sometimes, a lot of traders complain that they are not getting the leverage, right? They are getting order getting rejected when you are trying to. So this is because the execution order has to be correct. You have to have the buy order put first before you take the sell order. If you don't do that, you will not get the manage. Always put the buy order first. And also if you are exiting, you have to first exit sell orders, not the buy orders, because the buy order is exited first means you lose the leverage and then you will get into peak penalty and many other issues like that. So execution is very important. Position sizing is very important. These two are very important, when you are taking any kind of leverage. And when you are using hedging, you are doing some, you're risk defining, but sometimes you may end up over leveraging and over trading, which can ruin your life. So I'm just summarizing what we have seen. See, hedging gives you leverage. The other video in the risk management series, we have seen how collateral pledging helps you leverage. So you are leveraging by pledging your investments. You are leveraging by taking opposite buy positions and reducing your capital or margin requirements, and then you do the position sizing properly. You know what is the maximum loss, you know how much you can lose, how many lots has to be taken, how much loss will come, and that is what percentage of my total capital. So understanding all this is what risk management is all about, right? So you have to manage the risk, at the same time you have to make use of the leverage. You should not be under capitalized. Investments that is lying idle without doing anything has to be leveraged, right? Buying a far OTM will cut short your risk by half and will give you leverage both, right? Buying a buy position will manage your risk to very less risk, means you should go for that. So combination of hedging and pledging with proper position sizing is all risk management is about, right? This is what I wanted to summarize. I hope most of the traders would know that, but in case some of you are not aware, I hope you would go to the basket order in options in your trading platform, or like Kite or Zerodha, where uh, you can put your trades into the basket, and you'll automatically see what is the advantage of the leverage and that you will get. To know the risk, you have to go to tools like Obstra, where you can know what is the maximum loss, what are the risk parameters, what is the benefit, what is the risk reward, all these details you can go there. While execution, what is the margin that the broker gives, can be found from the terminal itself. So keeping in mind the position sizing and not over leveraging, if you make use of the spreading and hedging, you can benefit a lot, right? I hope it helps. Once again, I request you to please share the video to maximum number of people, in order for us to help us provide good videos in the future. Please hit the like button if you like it, and thanks for watching. Happy trading and happy learning. Thank you.